Very good morning, friends. Folks, at the outset, let me welcome each and every one of you for the Fast Track webinar series. This is for IBBI Valuation Exam, Securities or Financial Assets. This is 2020 syllabus and it is due for change any time. Maybe maximum in a month or two, you can expect a change in syllabus. Guys, today we are going to see a very, very important topic. In your syllabus, you have total 10 contents. Out of that, serial number 6 and 7, we are going to see. And this is your syllabus. The overview of valuation and reporting, documentation, and the approaches. I'm going to today. From price, value, types of value, premise, purpose, standards. Remember, guys, first time they included standards in your syllabus, but which standard they have not mentioned. So therefore, reading is primary, important. Many of the definitions you can refer to standards. Today I am not in Chennai, I am outside Chennai. I am in Tanjavur, which is, we call it as the granary of South India. I am from Tanjavur and I'm addressing to all the participants across length and breadth of the country. So I'm traveling and don't worry, wherever I travel, I'll be connected to you, hooked on to at 8:30 a.m. Let me first, these are the pointers where you need to prepare yourself for your examination, especially International Valuation Standards and ICA RVO Valuation Standards. The Valuation Standards was developed by Institute of Chartered Accountants of India by the Valuation Standards Board, adopted by, that standard is adopted by ICA RVO as a valuation standard. So I just refer that as an ICA RVO Valuation Standards. Good. Now this particular topic, it is referred in 103 of ICA RVO Valuation Standards as well as International Valuation Standards 105. So I'll be now and then I'll be referring only to these standards, and I also have the standards here 201, and this is your International Valuation Standard. So I'll be referring to that. Don't worry. Good. And this is a comparative chart of ICA RVO and International Valuation Standards. The numeric I have connected with respect to the inputs given there. Directly, I will take you to the first question. What is value actually? Remember, guys, two important words in value. Valuation is a process. Value is an estimate. Please understand. Value is an estimate. And remember, you use judgment of the professional. And this is the 5-line definition of value by ICA RVO Valuation Standard. And this is the International Valuation Standard Glossary 2022. In Glossary para 20.29 they have defined. And in both the definition, the word is judgment. Judgment of the valuer. Here, the valuation engagement using professional judgment. And value is an estimate. Here also it is an estimated amount. Okay, good. Now answer this question, guys. The value is an estimate of the value of a business or ownership interest. That means I am holding 7.5% equity. What is the value of that 7.5%? So that is called ownership interest. Arrived at by applying the valuation procedures appropriate for a valuation engagement. Okay. Sometimes they may ask you to do the valuation for the amalgamation purpose. Sometimes it will be for demerger. Sometimes it will be for liquidation. Sometimes there will be some issues. There will be legal, technical, various issues where you know about the particular property or the asset. So the valuation is different. So for valuation engagement and using professionals, what? Experience, knowledge, skill, all will be very close. But as per the definition, it is a judgment of the professional. That is why same asset on a same valuation date, if two valuers, Gopal is valuing Krishna is valuing. Two separate valuers are valuing same asset on the same date. Will the value will be same? Definitely no, because judgment change differs. So answer is 1B. Good. Now, synergy value. Now, all these what do you call this? Syllabus. What is fair market value, intrinsic, investment value, synergy value, market value, special value, going concern, liquidation value, purpose. All these are there. Price, value, definition of value. These are all in your syllabus. Now come to synergy. Now, please understand, before marriage, my earnings was 40,000. Okay. And okay, a boy and a girl. A boy's earning is 40,000. A girl's earning is 70,000. Post marriage, you mean to say their value will be 40 plus 30, 70,000? Actually, then the marriage will not take place. Marriage will take place when there is some delta. That is the combined value is more than the sum of the separate values. Separate value 40, 30, 70. No, it should be 75. That's synergy value. Synergistic value is the result of combination of two, provided combined value is more than the individual value. So please look at this photograph. I am sure yesterday it was February 14th. Today is February 15th. So how February 14th people were there, and then how February 15th how people are there. See, look at the synergy effect. Okay. So here also 2 persons, here also 2 persons, but some delta is there. No. Okay. So that is synergy value. Okay. Good. Now, synergy value is the result of a combination of two or more assets where the combined value is equal to separate value. Wrong. It's less than separate value. Wrong. It's more than separate value. Then only synergy. Otherwise, synergy will not happen. Nobody will be in. Either B or C is wrong. Okay. Good. Now, remember, guys, these three terms are not same. People always interchange. Fair value, fair market value, they interchange. Actually, it is not so. And in Indian accounting standards, fair value is like Mahavishnu. Because Mahavishnu takes various avatars, 10 avatars. Like that, fair value in Indian accounting standard will take different avatars. Net realizable value in India is 2, and value in use in India is 36 impairment, and it will take realizable, what do you call it, as revaluation, revalued amount. So that will be again a fair value. That is in India is 16. So fair value takes different avatars. So the definition of fair value with respect to India is different because the objective is different. Market value is a tax-related concept. Okay, fair market value and market value is a tax-related concept. In Indian circumstances, fair market value is defined in Income Tax Act. And that too, fair market value is defined in two different places. For example, fair market value in the context of, if you look at this, in relation to capital asset is 222B. And again, fair market value is defined in section 56 also. That is in relation to property. So fair market value in relation to property, separate definition. Fair market value in relation to capital asset, separate definition. So technically, the fair market value is a concept used in Income Tax Act. And market value, your CGST Act 2017, section 273, they define market value. And this is your market value as defined in IBS 104, where estimated amount, valuation date, willing buyer, willing seller, arm's length, proper marketing, and most important 3 characters should be there. Knowledge about the product. Prudent. There should not be any, okay, so that means with vision, and prudence should be there with respect to the transactions and without any compulsion or coercion. Okay, so these are the 3 terms. Now, please come to this point. Market value is the estimated amount for which an asset or liability should exchange on a valuation date between willing buyer, willing seller, arm's length, proper marketing, and party had knowledge, prudence without that means all of the above. So 3D. Now, what is fair market value? This is your income tax definition. So there won't be any question on this. So don't worry about it. But I am taking you to the fair value definition. This is fair market value definition. This is fair value definition. Fair value definition is given in your IVS 104 and this is your India's 113 definition. And your ICRV also gives the definition in ICRV 102 fair value. There also they define the same one. So it is India's 113 definition or IFRS 13 definition used in both the standards. So fair value, there is no difference between IBS or ICRVO. But with respect to market value, your CGST definition and your IBS definition, both are different, but I must make one observation here. Please look at this. It is required to pay because to obtain goods or services, same commercial level where the recipient and supplier are not related. So CGST perspective is different. Market value is a very generic definition. I will say this market value definition under IBS 104 is like an umbrella. Under that, your 273 market value definition will fit in. Okay, good. Now come to this question. Now, what is fair value? Now, fair value means what is the price that would be received? Please understand, this is called exit price, not entry price. Entry price means transaction price. Transaction price already what is paid, what is confirmed, that is called entry price, that is transaction price. Sometimes transaction price will be fair value, but not always. So that is why fair value is what would be received. As on 31st March, what it will fetch when I sell in the open market. That is why it's called fair value, but it is not market value. Okay. So market value can also be fair value, and your what do you call it as your transaction price can also be fair value. That is why I said fair value can take multiple avatars depend on circumstances. Okay, but you cannot equate this is equal to that. Fair value is equal to this. You can only give a generic definition where it would be received to sell an asset or to pay it to transfer a liability. Remember, this definition is applicable for both asset and liability. And would be received to sell an asset only, liability is not there. Would be received to sell an asset or paid to transfer a liability. Interested transaction, Govinda. Interested transaction is not, it is called orderly transaction. Okay. Interested transaction means that means related party will be there. And D, it is a forced transaction. So that is also gone. Now C, orderly transaction, would be received to sell an asset, paid to transfer a liability. Remember, fair value is also used to measure liability. Okay. Now, non-financial liability, how will you measure? Contract liabilities, how will you measure? Pollution-related liabilities, how will you measure? Okay. Good. Warranty-related liabilities, how will you measure? These are all non-financial liabilities. Okay. So you have to go by some logic. So there is fair value law. So 4C. Now next, let me take investment value. Now this is very important, guys. And I must tell you that in IBS 2022, this is your IBS 2022. So here in the glossary, this is your glossary. In the glossary, they have defined investment value in 20.11. And also worth, that is the last definition. Look at this, worth. Worth is also called investment value. Now come to this. And in the IBS 104 also, they have defined what is meant by an investment value. And remember, investment value is the value of an asset of a particular owner or a prospective owner for individual investment or operational objective. For example, there is a company where 10 people have invested in that company, equity they have invested. Now, one of the investor, he wished to exit, or he wished to know, see, I have invested 1 crore, all of them have invested 1 crore, so 10 crore. One day, the guy want to know, my 1 crore after 7 years, what has happened? Has the value gone up or come down? So that is why value of an asset to a particular owner or a prospective investor. Okay, maybe somebody wants to actually buy that particular share. So then he will be interested in that investment value. So he will pay to the shareholder and he will buy the share. So that is called investment value. And remember, guys, investment value will be entity specific. For example, that is a manufacturing entity. One guy is holding 12% share. So 12% share in the manufacturing entity, investment value will be different. Another company he would have invested, that company is totally different. For example, it is a service industry or an IT industry, okay, or an entertainment industry. So there he has some 18% stakes. So can I say that this manufacturing company 12% stake, same value will be 18%? No, that is different. So you need to, maybe the value of 18% will be even lesser than or even more. We don't know. We need to do. That is the entity specific. Investment value is entity specific. Someday it can be even less than cost also. So now Investment value is the value of an asset to a particular owner or prospective owner. And investment value is asset specific, owner specific, investment specific, entity, company specific. Please understand, company specific. So 5B, it is not asset specific. Okay, asset means your share, equity. Remember, this is the hierarchy. That is why I would have given this in the beginning itself. Please be very careful. Look at this. First, when you start a valuation, you should only start with purpose. Why you are doing this valuation? No. I know valuation. I know arithmetic. I know D1 by KE minus growth rate. What is D1? I know multiply, divide. All lot to you wanted to know. First, understand why you want to do valuation. Then go for base. Base means, is it fair value you are going to take? Is it market value you are going to take? Is it liquidation value you are going to take? Or you are going to take investment value? Or you are going to take what? Okay, that's very important. Okay, so then premise. Premise is actually for what purpose that particular valuation will be deployed or employed, will be used for. Okay, for example, you give a valuation. That valuation will be used for negotiation purpose. That valuation will be used for financial reporting purpose. That valuation will be used for resolution plan approval purpose. That is called premise. Please understand, base is different, premise is. So from base only, next step is premise. Okay, and these two go very together. So sometimes people will say, sir, premise first or base next, or base first or premise next. It is like a question like your anda or your chicken. Chicken first or anda next, or anda next, which will come first? Okay, hen chicken. Okay, so that is your. But the logic is first to go to base, and automatically you can fix premise. Maybe you fix the premise, base is also you can fix it. So that these two actually will go together. They are like a couple. Okay, they are like couple. So who proposes first is the question. Okay. Now come to the next. So I'm in which question? Yes, I'm in sixth question. Premise. What is actually premise? Premise is the assumed use. And I must tell you, this is the assumed use. Describe the circumstance how an asset or liability is used. And another definition, this is the definition of premise as per ICI. The premise refers to the condition and circumstances. Okay. How an asset is deployed. Deployed means bring into effective action. The premise of value refers to concerns and costs, no. Situation consequences, no. Situation conditions, no. Conditions and circumstances. So 6B. Conditions and circumstances, how an asset will be deployed. For example, say you somebody want to invest money in your company, 7 crores. Okay. Now you do the business valuation. You find the share price. Now, what that 7 crores will be used for? That is most important. Are you going to invest that in your company, land, building, machinery, working capital, and you want to expand it, marketing, expenditure, advertise, what you are going to do? Or that money will be used to acquire another company. So then premise is different. So because that acquisition will add value to your future, because when you go for income approach, how you are going to employ, how you are going to deploy the money, the return will be based on that. You are going to deploy in business, you are going to deploy in another company, you are going to spend on advertisement. So all this will decide your future cash flows. So your valuation will totally change. That is called premise. So please understand this, very important. Okay. And you need to understand that these things you have to disclose in your scope also, and also in your report. What refers to circumstances and conditions? Premise, not tenacity, not valuation process, not purpose is different. Purpose is the reason why you want valuation. Reason is different. The way the asset will be, the investment will be deployed, how the business will go forward, that is different. Okay, so please appreciate the difference. So 7A is B. Good. Now next question. Premise of value, this and all I'll come to. Going concern value. Now this is a very important question, and I must tell you one thing, that going concern is not defined in international valuation standards. Going concern is only defined in ICI RVO valuation standards. Okay. Now originally this valuation standard was developed by Valuation Standards Board of Institute of Chartered Accountants of India. We can call it as ICA valuation standards only. But since this valuation standard is adopted as their own valuation standards by the RVO, you can call this ICA RVO valuation standards. And in that standard 102 valuation base. So this is your 201. In 102, the para number 45 and 46, they define what is going concern. And you must be happy to know that going concern is the value of a business that is expected to continue to operate. Very simple actually, but that includes what? Intangibles. Going concern includes, because since it is a going, operating, okay, that means you have trained workforce. The trained workforce has a value. An operational plant has a value, because you cannot bring a machine, set it, run it. So immediately you can start. That is why we call that as a brownfield investment. Greenfield investment is not going concern. Greenfield means take the money, buy land, then put the fence, then dig it up, use the JCB, then construct, bring machinery. So all this, then do the testing, then licensing, so many. So going concern will have the license, will have the plan, will have the trained workforce, marketing, procedures in place, everything. So today, people also get married like that only. They don't want to go to Mantapam. They don't want to go for buying the vegetables, the provisions, cooking, everything they don't want to do. Only the point is they will only select the boy and the girl. Okay, that's all. The groom and the bride will be selected. Then date will be selected. All other are going concern only, because already the respective service provider will be there. The flower person will be there. The DJ will be there. Everybody will be there. Give the money. Everybody, all going concern. Straight away, these two have to, they go, get married and come back. Matter over. Okay. So in the intangible elements of going concern value result from a trained workforce. Yes, you should have it. Okay. Operational plan, yes, correct. Necessary license, yes. Okay. So your intangible is a result of all these only. You have all this. That is why it is a going concern. So all of the above, 8D. Good. Now come to, this is very important. Scope of work. A valuer must communicate scope. Yes. To whom? To your client. Okay. And valuer only must communicate. Sometimes you can ask, give the scope. The client may not know what scope is. And for your information, the scope, this is your ICA Valuation Standard 201. And here they give here are the following key elements of the scope. And with respect to your, this is your International Valuation Standard. Here they give the scope. This is the starting point. From 20.3, they are given 14 items. 1, 2, 3, 4, 5, 6, A, B, C, D, F, G, H, I, J, K, L, M, N. So 14. Out of that, 2 are optional. 12 is must. All are saying must. See, valuation, everything is used the word must be described, must be identified, significant action, types of report. Everything you must refer. Okay. So now come to this. So what is scope? Scope means the valuer must communicate to the client what? Okay. Fees he must communicate no. Fees is the engagement letter or appointment letter. So you give the engagement letter and he will give the appointment letter. Okay. So first you define the scope, then give an engagement letter. So first using the mails, you communicate the scope, confirm the scope, then give the engagement letter, then get the appointment letter. Okay. So in that only fees will be there. Draft report, nowhere in the standard they speak about draft report. But it is a general practice that we give a draft report before we sign, because let the what do you call it, as the client understand what we are doing. Okay, so that is being followed as a practice. Okay, and maybe along with the draft report, we will give the draft fee bill also. You'll say no, what is this? You add some more thing for the same fees. You do that also. All these will come. So these two are not there in the scope. Experience and all you will give in your visiting card or in your profile. Scope of work only you must communicate. Must communicate. See, these three, nowhere it is mentioned in standard. Scope only it is mentioned. And this is the ICA RVO valuation standard. The valuer shall follow the requirement of this standard while accepting an engagement. Valuer and the client should agree on the terms of engagement. See, should agree on terms. So, valuer must communicate scope. So, 9D. I must tell this particular point, guys. Nowhere in the ICA valuation standard or international valuation standard, they speak about report, but they have not defined what a report is. And only in the CBV practice standard 110. What is CBV practice standard? Canadian Institute of Chartered Business Valuators. In that, they have a practice standard 110, 120 in that. In 110, they have defined what a valuation report is. It is a written communication containing a conclusion. This is very important. So that means in your valuation report, conclusion should be there. You must conclude. It is not a disclaimer report. No, he didn't give me any answer, so I am not unable to value. Then you are not a valuer. You are neither a calculator nor a valuer. Okay. So then you are not a professional at all. So please understand, a valuation means there should be a conclusion. You must come to a conclusion. Otherwise, that engagement is not an engagement at all. So, and whether it is valuation, asset, etc., whatever it is. And there are 3 types of report. Please understand. Comprehensive, and this is an exam question. And consecutively, this will be an exam question. Okay, don't miss this. Comprehensive valuation report, where the fees will be very high. Highest estimated valuation report, fees will be middle. Calculation valuation report, you do only arithmetic. You don't corroborate the numbers. Whoever gives the numbers, you take, you calculate it and give. That is also calculation report. Please. Estimation report means to some extent you corroborate. So what do you do is called, it is called limited review or limited corroboration only. Maybe with respect to the current data alone you corroborate. Past data or future data you don't corroborate. So estimate valuation report is actually limited review. Okay. So for 5 and 6, fees can be negotiated. But comprehensive valuation report, please understand, that is why in your report, you must tell the type of report. That actually, I must say, even though what are the different types of report, valuation, international valuation standard, they don't mention, but they mention the type of report being prepared. The format of the report, that is how the valuation will be communicated, must be described. It doesn't mean that you give a dummy format of a 20-30 page report. No, you should say what the type of report is, what the content of the report will be, at least the headings. So, and get it confirmed. This is scope actually. You must give this as part of the scope. The type of report, you must give this as part of the report. Scope itself, you must say. Okay. So, okay. And because your fees will depend upon your comprehensive. So, let me take you to the question. So, the question is, which of the following is not a type of valuation? Comprehensive, estimate, calculation, complete. There is no type called complete valuation report. Actually, all are complete only. Whether it is comprehensive, estimate, or calculation, all are complete. Now, remember documentation. Now, this is para number 45, ICRVO valuation standard 202. They say what the documentation will contain. Okay, right from the engagement letter, appointment, tabulation, working copies, base, approach, assumption, everything should be there. Copy of the signed valuation report. And remember, inclusive, not exhaustive. Documentation includes record of the valuation procedures performed. How did you do the valuation? Okay, inspection, discussion with the client, interview, okay, photographs, okay, and you compared with some market data, and you corroborated the past data. So all this relevant evidence and conclusions that the valuer has reached. This is documentation. Now, valuation documentation means what? Record of valuation process performed, yes. Evidence what you have obtained in terms of the numbers. Because, see, valuation is only pure number game. And this number, remember, is valuation is an audit? No. And I must tell you that, please, this is one place where ICA has made that very clear. Please look. Valuation shall not be constituted as an audit or review in accordance with auditing standard. You can even put this in the valuation report. This valuation is not an audit. This valuation is not a review. Because audit means you have to give opinion. In audit, you don't conclude. In review, you don't conclude. Only in valuation, you conclude. But the conclusion is an estimate. Estimate based on judgment. Okay. Please be very clear. Now, all of the above conclusions. So 11D. Good. Now come to the next one. Now various approaches. There are only 3 approaches: cost, income, and your your cost, income, and your market approach. So all the three. Now these three approaches I'm going to discuss. Okay, please understand these three approaches are they may not miss any question from this. And remember, this is your IBS 105. They explain about cost approach. Cost approach means what? Okay. Cost approach provides an indication of value using the economic principle. The buyer will pay no more for an asset than the cost to obtain. What do you mean by that? Okay. And this approach will indicate the value by current replacement or reproduction cost. For example, I'll tell you what is cost approach. Now, a machine, okay, a machine, you want to know the value of the machine. For example, it is a generator, okay, a very heavy duty generator. And in your book, there is a book value, okay, the net asset value. So you bought that generator for 8 crores. Now the book value is 3.2 crores. Okay, now, is it a value? Now, that generator is not manufactured at all, but very good generator, very good working conditions. Now, please understand, if the generator is bought today, okay, if it is manufactured and sold, you will get a quote from the company. Sorry, I want to buy the same generator now. He will give a quote. Now, that is called the current cost. Maybe you would have bought 8 crores, maybe 6 years back. The same generator, if you buy it today, it is not 8 crores. Maybe it will be 12 crores. It will be 15 crores. 15 crores is current cost. But the generator, what you have is actually 7 years old. So from the 15 crores, you do the depreciation. You will get the current replacement cost. That is called cost approach. Okay. So now, which is the valuation approach that currently, that would be required currently to replace? Current cost. Okay. Please understand current cost. So that is called cost approach. So 12C. And remember, there are in ICAI, they give only 2 methods: replacement, reproduction. Okay, I will explain now what is called replacement and reproduction. Replacement, just now I explained with the example. Now, reproduction, I will explain. Okay. Now, replacement, I gave an example of the generator. Reproduction, I'm going to give now. Okay. Now, in ICAI, 2 methods only is discussed. Look at this. 2 most commonly methods. And in IBS, they say broadly 3 cost approaches. Broadly. But again, these 3 are not the end. Can you say net asset value is the cost approach? I will say yes. But net asset value has not been treated as a method at all in the valuation. In the entire valuation standard, net asset is not there. But Income Tax Act recognizes net asset value. Okay. Net asset value, book value is recognized by income tax. So income tax approach is different. But evaluation standard doesn't recognize net asset at all, for your information. Okay. How many methods are there broadly used? Please understand. Broadly, there are 3 methods, but ICA is commonly 2. Okay. So broadly means 3. Now, what is the third method? Third method is summation method. Wow. What is summation method? Example, I'll give a classic case. You are a holding company. Okay, you are a holding company. In holding company, you have invested in, say there are 7 subsidiaries. Okay, there are 7 subsidiaries. So subsidiary 1, you have invested, 2, invested 3, all 100% subsidiary. Now, holding company is invested by 5 shareholders. 5 shareholders. Now, one of the shareholder, he wants to exit. He wants to sell that share to the one of the 4 shareholders. Out of 5, one wants to exit, and the other 4, anyone they want to buy. Okay. Now, I want to know the value of this share. The holding company is the 1/5 share. Now, if I have to find the value of the 1/5 share, this money is invested in 7 companies. So, I will find the value of company A, company B, company C, company D, company E, company F, company G. Sum. Okay. Summation is the value of the asset by addition of separate values of its component parts. That is also cost. Okay. So very interesting. So now come to this question. So 13 over replacement. Replacement is recreate an asset with substantially the same utility. Now why? That is why I gave the example of the generator. You already bought the generator 7 years back. Now go to the market, find out what is the same generator. If it is what is its price, but that price you cannot take because substantially the same utility means you have to depreciate for 7 years. So that is called comparable utility. So then it becomes cost. Okay, that is called the current cost. The word current is very important. Current is very important. Cost approach, historical, international valuation standards and India, the ICA valuation standard doesn't use the word called historical cost. They use the word called current cost. Historical cost and current cost both are different. Please understand. The valuation standard dumps to the recycle bin the word called historical cost. It is only current cost. Okay. Now look at the word. Now what is called this replacement? Replicate, recreating the substantially same. Now generally replacement cost is the same relevant to determining, okay, on replicating the utility are not exactly the physical properties. Now I want to bring to your kind attention one word called reproduction cost. Okay. Now look at this Agnipath. One Agnipath is Amitabh Bachchan, and that Agnipath is even today. Amitabh Bachchan cannot recreate that Agnipath magic because that style delivery, my God, the charisma what he had in Agnipath is phenomenal, and that is why he got the national award for Agnipath. And that Agnipath was tried to what you call repeat in the latest Agnipath. That is where Hrithik Roshan. Okay, the Dawn Agnipath, the Amitabh Bachchan Dawn is different, and Shah Rukh Khan Dawn is different. Okay, Billa, Rajinikanth, superstar Rajinikanth, Billa is different, and your Billa of Tala Ajit Kumar. Okay, that is different. Okay, Tala is Tala, superstar is superstar. Okay, so this Agnipath is they try to actually duplicate. So remember, guys, the reproduction means recreating a replica. Okay, in Tamil there is a very beautiful movie called Tillana Moganambal. The Tillana Moganambal, the chemistry between the Natya Peroli Padmini and Shivaji Ganesan and Manorama and various other artists, you try to replicate. I repeat the word replicate. You try to replicate it. It is not possible. Certain things are not possible today. You can only reproduce. This is called reproduction. For your information, is reproduction only, not replica. Okay. So that is, so what involves valuing an asset based on the cost that a market participant shall have to incur to recreate an asset substantially the same utility. That is called replacement. Substantially the same means replace. So 14A. Now recreating a replica. Normally recreating a replica you can try maybe for certain product. Okay, certain model from something where you have a model, you look at it and you try to recreate it. So then it is called reproduction. Okay, so please understand the difference, slight difference between replacement and reproduction, because both the words in replacement also the word recreating will be there. In reproduction also the word recreating will be there because both are recreated. But reproduction is replica, but in replacement with substantially the same utility. Okay, if it is not possible, substantially the same utility. Now I will say Hrithik Roshan Agnipath is not reproduction, it is only replacement. Okay, similarly Shah Rukh Khan's Dawn is only replacement, and Tala Ajit Kumar's the Billa is only replacement of superstar's Billa. Okay, good. Now come to this very, very interesting term, guys, called weight and weighting. Okay, weight and weighting is a superb definition is actually given in the International Valuation Standard. This is your International Valuation Standard. In the glossary, the last they have given this to 20.31, 20.32 weighting. Okay. Now, please look at this weight and weighting. Now, what is this word weight? Especially weight refers to the amount of reliance placed on a particular indication of value. A particular. I'm giving weight to a particular indication of value in reaching a conclusion. Okay. Weighting. The word weighting refers to process of analyzing, reconciling, differing indications of value. Okay. So now, there is a boy. The mother is actually seeing a bride for the boy. So she will take some 5-6 photographs. She will actually shortlist. Okay. The would-be mother-in-law. She will shortlist. I have just shortlisted 5. Okay. So the process of analyzing and reconciling differing indications of the values. Look at this. This girl is from Tiruchirappalli. Look at this girl is from Guwahati. This girl is from Delhi. Okay. She is educated. She is that salary. She is earning this. So all this. And then weighting is process of analyzing, reconciling. They'll put a lot of attributes. Okay. Similarly, nowadays, the same is done by the girl side also. The girl, maybe the girl's mother may not do. Nowadays, girl, they do it. They take all the boys' photograph, put all the character biodata. Nowadays, they even take the medical report also. They put all the weight for it. Okay, that is called weighting. So then, who gets the mark? Okay, the Gopal gets 17 marks. Krishna gets 33 marks. Okay, then that is called weighting. Process of analyzing, reconciling the differing indications of value. Please understand. That means I'm not averaging. Okay, all the boys looks very nice. Okay, it is not possible to marry all. Okay, please understand. So you have to do the also same. So you have in what do you call it as the market approach is there, income approach is there. In market approach, 2 methods you are taking. Income approach, 3 methods you are taking. Cost approach, 2 methods you are taking. Now which is value? So now you have to do the weighting. This, and then reconciling. Okay, this seems to be better. And then give weight 100%. Okay. Remember, valuer is not a calculator. You have 7 values. So add all the 7, divide by 7. Are you a calculator? You have 7 values means take average. Or you want to give weight for it. I will give 10% here, 20% there, 15% here. Are you a statistician? No, you are not a statistician. You are not a calculator. You are a valuer. Okay. A valuer uses judgment. Judgment means you have to use your top floor. You have to use your top floor. You should not use calculation. Okay. Top floor has to be used. Okay. That is called weighting. But now come here. What is a valuation approach? That uses price and other relevant information generated by market involving identical. Remember, guys, this word market means identical or comparable. Look at IVS 105. They also use the word identical or comparable. In market, you take one. So I want to know the value of my car. Okay, I'm owner of Benz. Okay, so I'm owner of Benz of E-Class. Okay, E-Class Benz, which is only 2-year-old. I want to know the value. Okay, then an identical Benz which is 2-year-old, which would have just now sold. That is why price information is available. This is most important. Sometimes price information is not available. Market approach is worthless. So identical, comparable information available. Identical, comparable and available. All should be there. Then only we'll go for market. The word identical, comparable is also there even in ICRBO. So now the identical or comparable with market approach. Patar you must write. Patar 1415D. Now I'll take you to this PORI and port is very important. Okay. PORI means price of a recent investment. Port means price of a recent transaction. Now, what is PORI? Now, what will happen, especially startup companies? Startup companies, I would have invested some 4 friends would have joined together. Each will put 10 lakhs and we'll start one company. And after 3 or 4 years later, we need more money. A new investor will come. At that time, I will do the valuation. So he will invest some 40 lakhs. Then with that, we'll go. Company will grow. We need more money. Second time dilution will happen. First time dilution, first investor. Okay. We are promoters. First 4 are promoters. Investor is coming first time. Now, second time investor is coming. Then second time dilution. Now, when you are doing the valuation for second time, remember, you have already done the valuation for the first time. So, the fair value indicated by a recent transaction in the investee company. Investor is outsider. Investee is internal. So, you already have a valuation. From there, you do You do calibrate. What do you call calibration? Remember this word. Calibrate means doing an adjustment in accounting is a sin. But not doing an adjustment in valuation is a sin. So you have to do calibration. No. 1.5 years back, I did the valuation. Same value, when can I take? No. The value appreciates or depreciates. Same happens. Okay, even in marriage also. So before marriage, so many words will be said. So you are like that, like this, so many things they will say. Post marriage, whether appreciation happens, depreciation happens. Okay. The person is same. Okay. But calibration happens. Okay. Calibration means going up or down. Okay. So what is recent investment? Recent transaction. Now, an investor wants to invest in a company. He doesn't know the value. A similar company, somebody has just now invested, similar type of startup. So they invested. They did the valuation. So that valuation I can take and I will do the calibration. I will do the adjustments. So that adjustment is very important. So the precedent transaction analysis, where the past merger and acquisition transaction used to value, comparable, like a market data. Comparable. Now here what is compared? My own company's data I am taking. Recent transaction, the same. So now you tell me which is PORI or port. Fair value indicated by recent transaction in the same company means PORI. Okay. Recent investment. So 18B. Now, what is a precedent transaction is also known as. What is called precedent? Now look at this word. Okay. Comparable company analysis. Okay. This is called, other port is otherwise known as precedent transaction. Some recent transaction. So comparable, precedent transaction. Both are same. Okay. So this word is very important. So it is called port. So 19A. So go through all this stuff, guys. Very, very important. Okay. Now, this is the weight and all I've already discussed. Now, Gordon model, I must tell you, only in ICA RVO, the Gordon growth model has been explained in detail. In detail. Okay. And this is your formula. Okay. This is your formula. D0 equal to 1 plus growth rate, and that is your D1. D1 divided by KE minus growth rate. Now, the terminal value means 1st year, 2nd year, 3rd year, 4th year, 5th year. 6th year onwards, you don't know, you are not able to, you are not able to judge. So then you go by a constant growth. So that is why the Gordon constant growth model evolved. This is your definition of Gordon constant. Terminal value is computed by dividing the perpetuity maintainable cash flow. That is your 7th year or 6th year onwards, what will be a cash flow? Constant growth rate divided by KE minus growth rate. This particular formula is not taken from clouds. This particular formula has a derivation using geometric progression. Okay. So therefore, as a valuer, don't go by all these formulas. Go to the roots, fundamental, how this formula is actually derived. Understand the mathematics. If you know the mathematics only, the concept will be very clear. So, concept will be very clear. Maybe since I'm in the 1 hour session, I'm giving you all the pointers. Please go through this. This formula is not taken from clouds, not from any textbook. Those are, derivation is there. Proper LHS equal to RHS, left hand side equal to right hand side. Derivation is there. Please do the derivation and try to do your derivation on your own. I'm telling you, any valuation you can do on your own. That derivation alone you do it. Any valuation, you don't need to copy any formula model. Can you give me that that valuation format? This valuation? No, you can design yourself. I'm telling you, you are a valuer. You can do it. Okay. So this is called Gordon constant growth model 20A. But now come to the next. Now please understand this paragraph. IBS 105 para 10.4. When you are using more than one approach and more than one method, say I'm using market approach and income approach. Under market approach, 2 methods are there. Under income approach, I take 2 methods. So there are 4 methods are there, 4 values there. Now which value you will take? So then the conclusion of value, how will you arrive at? Will you take the average? No. Never the standard says you have to do average. The conclusion should be based on those multiple approaches should be reasonable. The weight and weighting. See, generally, will the boy will say, Amma, I will marry more than one girl. That means she will take the chappal and mar denge. Okay, so please understand that. So you give weightage to one girl more. That is agreeable. Okay, be reasonable. So, and our method should be reasonable, and the process of analyzing and reconciling the differing valuer into a single conclusion. That is most important. So for that you have to arrive at, you give reason. No, that Delhi girl, I like it. Okay, that she is more well qualified, more earnings is there. You give some reason. That reason is right, wrong, good, bad. That all judgment. Judgment will differ from person to person. Okay, so that is not to be questioned at all. Okay, nowhere the standard says which judgment is right, which judgment is wrong, because you are human being. Judgment will be different only. Okay, so when more than one approach and method is there, or even multiple methods within a single approach, the conclusion of value should be correct, exact. It is not possible. Accurate, never correct, exact, accurate, and all. It should be reasonable. You conclude why you are rejecting the other methods, why you are accepting this method. That is most important valuation report. You have said that 23C. Okay, good. Now equitable value. Now there is a neighboring property. So right hand side is your property. Neighboring property is kept in lock and key. Okay. Now you have some money. You want to invest in a property. Rather than investing in some other property, is it wise to invest in your neighboring property? Yes. And do you know more about the neighboring property? Yes, I know more about it. The advantages also I know, disadvantages also I know. Now, participant specific value is the value, estimated value, because you know, considering the specific advantages or disadvantages of either of the owner or intended acquirer or identified participants. Okay. Now, as a owner, you want to value it, you know about it. As an intended acquirer, because he is the seller, he is the owner, he knows about it. You are the buyer, you are the intended acquirer. So you also know about it. That is what it's called participant specific value. Other is called equitable value. Equitable value is the term given by IVS. Participant specific value is the term given by the ICA RVO valuation standard. So please be careful. Now let me answer this question. What is the estimated value of an asset or liability considering specific advantage or disadvantage? Is fair value wrong? Intrinsic value wrong? Special value wrong? And participant value, yes, 24C. Actually, intrinsic value is called as your book value. Okay. Now, Habu, very important. What is Habu? Non-financial asset. How will you value? What is non-financial asset? Plant, machinery, books, land, building, intangible asset. Okay. How will you value? Okay. Now, it all depends upon if 2-3 buyers are coming. There are 3 buyers are coming. Each buyer will use the assets in a different perspective. So based on his use, he will offer. So that is why offer, 3% will give the same offer. No, that offer depends upon the property that will give value to him. So that is most important. So this is most frequently used for non-financial asset, although you can use it for financial asset also. Maybe you can use. So there may be circumstances where Habu can be used for finance. Why it's called Habu? Habu means highest and best use. 3 people are giving value, means the guy who will use it better, he will give more value. Okay. So highest and best most frequently applied to non-financial. So 25B. Okay. Now I'll take you to some questions. Okay. This is most important. Remember, guys, there are 3 types of market when you go to. One is called principal market, active market, most advantages. Okay. And in fair value, first you have to go to principal. Principal market means greatest volume. Meaning, you want to buy your vegetables for 1 week. So then where will you go? Will you go to the next door, next street, Shendil Kadai or Murugan Kadai? Or will you go to the Coimbatore the market or the Kotaval Savadi market where bulk will be available? So you go to principal market where greatest volume of flowers, fruits, vegetables will be dealt. Okay. In the absence of the principal market, that is because the market is elsewhere, you are in a very small town or village, then go to the most advantageous market. That will maximize the amount. So, or minimize. It is a cost means go to 3 or 4, go to Sendil Kadai, go to Murugan Kadai, go to Annachi Kadai. Which Kadai is actually giving you lesser price? Go there. That is the most advantageous market. Now, what is active market? Go to the nearest market where maximum routinely daily. See, sometimes the provision store will be two building, next building will be provision store. So then what these ladies will do, no, they will not have all the provisions in their kitchen. So they want kadugu, they want ulthambarupu, they want the what do you call it as oil. Immediately go and buy that 50 gram. This is buy and 50 gram. Uppu, go and buy 50 gram. This is an active market. This is not, I don't go to principal market. It's an active market. Routine. So please understand that word. Which is the market that maximizes the asset or minimizes the cost? Most advantages. 32C. Which is the market that routinely experience? Routinely means active market. Okay. 33A. Now I'll take you to one. This is some of the parts which I told you. We see some of the parts is that summation method. Summation method where you will use holding company, conglomerate company. One company has invested in multiple different business, multi-divisional company. So there you will use the summation method. So some of the parts method or summation method or breakup method is a valuation method used for multi-division correct, holding company correct, conglomerate correct. A startup company you will not, because that is only single company. You will not use that. So 34C is the wrong. That is your right answer. Okay. Now let me take one question, guys. Okay. Look at this question. I think we'll do this to understand. 31, I will do this. This is 31. Okay. So what I will do. So look at this. So this is you're following on the projected cash flow to equity and to firm over the next 5 years. Cash flow to equity. Now, what is cash flow to equity and all? I have to discuss for minimum 15-20 minutes. Okay. So 250 is first year, 262.5 second year, 75, 289, 303, 3946. This is your free cash flow for equity. And your terminal value is this is terminal value. And how terminal value is arrived at? D1 by KE minus growth rate. This I will do it in another case study. Okay. The cost of firm, cost of equity is 12%. So this is your 12%. At 12%, you discount it. Okay. So 1 divided by 1 plus R, the whole power n. Okay. So this you freeze it. So now this is your now your terminal value also you have to take the same 50 So this is your value of equity 3224. Okay. So what is the value of equity? 3224. So 31A is B. Now, what is your cost of value of the firm? Value of the firm means it is not you will not take the free cash flow. You will take of the firm. Now, free cash flow of the firm is free cash flow of the equity plus interest into 1 minus tax rate. So 250 plus 90 is 340. 262.5 plus 94.5 is 357. So, so this plus this. So that is your free cash flow. Now your weighted average cost of capital is 9.94 because you are 12% plus your debt. Debt will be always cheaper. So average cost is 9.94. So 9.94 means you take the PV factor. So 1 divided by 1 plus R, the whole power n. This is your one. So this is your, and freeze this now. And copy this for all the now for the 5th year you have to take this same. Okay, so now this is your value of the firm 5149. What is the value of firm? 514. So 31B is C. Okay, good. And maybe one more last question I will take and after that I will leave the firm for you. The commonly used multiple. Now please look at this. Generally in a valuation, especially using market, you have a comparable company. That comparable company, what I will do is value of the firm and what is the earnings. Earnings is 40 lakhs, earnings is 400 lakhs. So 40 lakhs earnings, valuation is 400. So what is the multiple? 10 times. Okay, that is called relative. The same 10 I will take. My profit after tax I will multiply. So that is called relative valuation. Now come here. The commonly used multiples based on enterprise value, based on enterprise. EV by EBITDA. EV is rupee, EBITDA is rupee. EV is rupee, EBIT is also rupee. This is also multiple. You can take that comparable. EV is also rupee, no PAT. No, it is net operating profit after tax. That comparable. EV is rupee, P ratio is a ratio number. This is not a multiple. You will never get a multiple at all. Multiple you will get only when you divide both by rupee, percentage by percentage. Okay, or a number by number, days by days. Then only you will get a multiple. A rupee by a percentage or a ratio, will you get a multiple? No. So D is a wrong answer. So 40D. Okay, good guys. So friends, I am sure we had a wonderful time in going through everything. Let me now ask any one of you to share your thoughts, please. Sir. Can you please raise your hand? Only 5 minutes. I will not take more than 5 minutes. I will just request you to please stick on to the session for another 5 minutes. Okay. So let me now invite a few of our friends. Can I request Mr. Balasubramaniam? Mr. B. Balasubramaniam, I'll request. I'll also request Mr. Rajkumar Kotari. Okay. I will request Mr. G.S. Murthy also to share his views. Mr. E. Ganesan, I will request to share his views. Jaykant is there. Can I request? Are you
able to hear me, sir?
Absolutely. Clear and loud, Mr. Rajkumar Kotari. Good morning. Please introduce yourself and share your thoughts.
Myself, Rajkumar Kotari. I am practicing since last 20 years. 2002, I have passed. Thereafter, I have completed insolvency professional also. And recently, I have completed DISA also. And many certificate courses I have also completed. And first of all, I have to say thanks to you for your DISA batch. Because in that batch I have attended your all the lectures, and I was inspired by your all lectures and deliberation. It is really mesmerizing and encouraging to all of us. So thank you for that. And today also I am still pursuing this valuation examination also. So hope with your guidance and deliberation I am able to crack this also. So thank you very much,
Mr. Rajkumar Kotari.
I am from Aurangabad, sir.
Aurangabad, okay, very close to Sai Baba. Okay.
Yes. You are welcome, sir, anytime. And whenever you visit Shirdi, please call us. I will have pleasure to meet you, sir.
I am actually fascinated by your Aurangabad branch, the infrastructure, amazing infrastructure.
Please do come, sir. And it is proud to say that during the year when infrastructure was getting completed, I was the chairman. It is my pleasure to sign all the checks for the infrastructure.
Amazing. So very, very good. So thank you very much, Rajkumar Bhai. Now let us hear from Mr. We have Matthew John Mawelil. Matthew John Mawelil, can you unmute and share your thoughts, sir? And we have Mr. M.S. Subramaniam. And we have Hemalata Krishnamurthy. Hemalata Krishnamurthy. We have Divya. We have Divya Dadda. I've just unmuted you. And we have Mr. Balasubramaniam. Yes, Mr. Balasubramaniam, I've unmuted. You can also unmute and share your thoughts. And yes, Mr. Balasubramaniam. And Vinit Kumar Gupta, you can also share your thoughts. Yes, Mr. Vinit. So, Jaykant, you can share your thoughts, please. Jaykant, you can unmute.
Can I be heard? Am I audible?
Absolutely. Clear and loud. Kindly introduce and go ahead.
This is Vinit Kumar Gupta from Noida, and I have practiced community secretary with more than 25 years experience. It's a very good session, very nitty-gritty and well explained, and the fine concepts have been explained very good. Thank you very much, sir. It's a pleasure attending your session. I have attended many sessions, I have attended many classes, but it's I think one of the finest classes I'm attending right now. Thank you.
Thank you. Now let us hear from Mr. Balasubramaniam.
Yes, sir. Good morning. Sir, very good morning, sir. Pranams and very good morning, sir. First and foremost, sir, I have been able to qualify as an insolvency professional courtesy, sir. Because of your valuable inputs, I was able to clear it. I was working in State Bank of India. I retired recently as a deputy general manager, looking after the credit portfolio. And I think the services which sir is giving, I think is immaculate, sir. I think probably the way in which sir is explaining in a very lucid manner, because I am being a non-commerce graduate, I think I found it very difficult in while going through the papers. But after hearing your classes, I think it is very, very thoughtful. And the examples which you give, we just cannot forget that, sir. That is one thing which we can relate. That is the best thing, sir. Thank you, sir. Thank you very much, sir.
Now let us hear from our Sampath Kumar Ji, sir. Very good morning, sir.
Good morning, Dr. Raju and my dear participants. Very rightly mentioned by the other participants that I am one of the great beneficiary and admirer of Dr. Raju. I cleared this valuation exam only because of the support from Dr. Raju a year back. Every time when you listen to Raju, today also maybe many times I have listened to him with respect to valuation approach. The fundamental principles very nicely, purpose, base, and premises, approaches and methods, and various concepts were very lucidly explained today also by Dr. Raju. Thank you, Dr. Raju. We are eager to attend the next classes also. Any number of times I want to listen to you to have further insight into the subject. Thank you, Dr. Raju and my dear participants.
And maybe last but not least, maybe have Rajendra Kumar C. Can I request you to kindly unmute and share your thoughts? Mr. Rajendra Kumar, can we hear you? Maybe, right. Maybe we'll hear him tomorrow. And friends, in another 10 to 15 minutes, I'll upload the material, today's material in the blog. You can go and download it. And also tomorrow's session also, the link, registration link also will be available in the blog. You can download from there. And one request to all of you, please give a line or two feedback in the blog itself. Below you have a feedback. Just give your comments about the session. Please write there, and already few of them are sharing their thoughts. I request you also to share your thoughts while you are downloading the material as well as registering for the next day. Thank you. Best wishes.